So I think you start the co-investment journey by sourcing co-invest. So that means as an LP, we should have a very good relationship with the GP, and that is not to be underestimated. It's just a relationship game. We've been investing into funds for the last 20 odd years. And on the PE side, what we have found is that we like bigger funds and experienced fund. If your target fundraiser is $200 million, then that is interesting for us, 200 and above. We like experienced fund managers, again, because everybody makes mistakes and we're all learning constantly. But since our balance sheet has to be maintained, we'd like you to make the mistake with somebody else's money. You have a dollar fund typically, and you invest in local currencies. If you look at the rand, the naira, the shilling, pounds, or Egyptian pounds, they've all had substantial devaluations in the last 5 to 10 years. And there is just very little you can do against that. Even if your business grows tenfold, even then it's really hard to translate that in dollars again and still come out on top. Between the local currencies and then whatever hard currency we're talking about, local capital is always best, and that's that's the reason why we exist, to foster that local capital.
Hi everyone, and welcome to this new episode of Akinia Talk. We are with Johann. Thank you, Johann, for joining us today. And to starting off, I propose one so you can introduce yourself, so we have a great view on your role at DEG and your journey to investment.
Sure. Thank you, Frank. Thank you, Christian. It's a pleasure to be here. I'm Johann, investment manager with DEG. DEG is one of the European DFIs. I started off about 5 years ago after a bit of experience in asset management and in Munich, but wanted to have more exposure to Africa due to personal ties, and found the Young Professionals program at DEG after finishing my master's at LMU in Munich and master's in finance. And long story short, I'm now based in Johannesburg at DEG's largest foreign office, which aligns quite well with what I wanted, i.e. be close to the continent, work in the market, because DEG's headquarters are in Cologne, Germany, and you always feel a little detached from what is actually happening on the ground. Okay. And now, I've been here for good year now, and gives me much more exposure and gives me much more insights in what is actually happening. So I'm quite happy about that.
Okay. Thanks a lot, Johann, for your presentation. You just told us about some personal ties that take you to work for a private capital in Africa. So at the DEG, can you maybe tell us a bit more about that? Is it more a family thing, or is it also something else?
No, there's it's twofold, right? I think there was a bit of I'm born and bred German, as German as they get. Not only by name, but also by upbringing, right? But then I traveled a fair amount, traveled through Africa, and while studying finance, I felt like, okay, a dollar here can stretch much further and can achieve much more than it could somewhere else, i.e. in Europe or the US. And the entrepreneurial, the forced entrepreneurial spirit that you of course have to have in Africa and in general is something that appealed to me and that I admired quite a bit. It comes from not a place of there's no choice but to be entrepreneurial, but I admire that quite a bit and thought the contrast was very stark to what I was exposed to during my finance studies and then later work, where it's large sums of money, then you haggle for basis points pretty much. That was in the asset management position that I had. That didn't feel as impactful as, let's say, trying to be active in Southern Africa, right? And so that was one tie, and then the other one is this person was my wife is South African, which that just happened. So then there was a much stronger pull to that region.
Okay.
Suddenly.
Yes, we can understand. Thanks a lot for this answer. Maybe before going further, we'll present Akinya and what this initiative is about.
Yeah, so the goal at Akinya is to aggregate and to facilitate work of the private capital ecosystem in Africa. So our goal is to aggregate information about funds, companies, transactions, and advisors in order to more for the private ecosystem to be more interesting and to facilitate the clarity of the data. So this is why we are here, and this is why we want to talk with many different people of the ecosystem, and so our next question, and to go a bit deeper of DEG. So Johann, can you introduce you to DEG? What is DEG and what is the role of a DFI?
Yeah, sure, Frank. DEG, as I said in my intro, is one of the development finance institutions, short DFIs. Most European countries have one, I'd say, and then there's the World Bank that has one that's called the IFC. They all have a common goal, which is to grow private markets, as in that, it's common knowledge, and it's been an issue for years that there's a lack of private capital in the markets, and the idea is if we, bring capital to those markets where there's a lack thereof, we, create jobs, we create fair jobs, and we better lives in developing countries. Most DFIs and have a sort of kind of a dual mandate. So there is some sort of the core mandate is impact. So that's the development part that I mentioned.
Okay.
And then some have financial goals as well. And DEG, I guess, is very balanced in this, as in we have a impact goal and then also financial goal. DEG was government founded, but is not government funded. And that's a very interesting distinction to other DFIs in Europe, is that we run our own balance sheet and therefore need to be self-sustainable, which makes us more commercial and less, let's say, risk-taking, because we need to keep our balance sheet or actually grow it just in order to stay around. We try to align that with our strategy of climate impact and return. So climate is basically the goal to reduce our greenhouse gas emissions to 0 by 2040. So a little sooner than the 2050 goal, right? And we try to do that with a mix of reduction in greenhouse gas intensity of our portfolio. So we're shying a little bit away from greenhouse gas heavy investments like, concrete, any oil and gas, that's all phased out. And then we do invest quite a bit in sequestration, i.e. forestry, just to whatever we can, reduce to offset that by growing forests, as we find that the most honest way to sequester and to reduce carbon emissions. Then impact, we'll get to that later. That is sort of kind of what our dollars or euros in the ground actually change on the ground in terms of reality for people and the government, people in surrounding markets. We get to that. And then return, it's self-explanatory. We need to be self-sustainable, which, yeah, again, I think is quite a good, healthy goal to have. It makes us less risk-taking, as I already said. So DEG is not the first DFI you may want to talk to if you have something untested, something that's new to the market, because we are not able to take that kind of risk.
Okay. So when you mean like that DG aim to be self-sustainable, like what do we mean about that? Like, can you explain a bit more?
Yeah, so that pretty much means that we need to grow our balance sheet. Since the 60s, we've grown it now to about 9 billion euros. As a fully regulated German bank, we have to comply with all the capital adequacy ratios that a bank typically has. And we aim to, grow our balance sheet, let's say 5, 6, 7% a year, more like 5. And that means, our investments have to, on average, be profitable and more than break even, right? There is a debate on how profitable or not profitable we should be, and the impact and climate goals are the overarching goals.
Okay.
In terms of, those are our North Stars, but then they're subject to, we shouldn't lose money.
Okay.
So that's also the interesting, I think, aspect of it, because if you talk any investments, there's always 2 points to it, right? One is what's the impact on the ground, but what does it do to our climate impact, and then is it sustainable in terms of financials? And that is always a discussion to be had.
Yes.
Yeah.
Okay. Thanks a lot for this answer. Maybe before going like a bit deeper at what DG is doing, you told us about like your graduate program that you attend, like in order to enter DG. It was in 2020, right?
Yeah.
Yes, okay, 2020. Maybe for the students that are hearing us, can you maybe like give us a deep dive on this program? How do you manage to enter it? How's your their resume looking like all the small tools, I'll say, that can help like the students that are being helped today.
Yeah, sure. So yeah, I joined the Young Professionals program, I think middle of 2020, which was in the middle of COVID. So I can't tell you what the program looks like now, because it was very different back then. And the idea basically is to get to know the institution and the wider group, KfW being the parent company of DEG. And the idea is that you do, I'd say, 4 to 6 little internships back to back within DEG. So you get to know front office, back office, middle office. You get to know the foreign offices. You might have a 2-month stint in any of the foreign offices.
Okay.
And that with the aim to get a very well-rounded picture of what is happening in the company, and to know the actors in terms of how they work together through the investment process. And then to eventually, find your home, quote unquote, after that series of stints across sectors and departments.
Okay.
To also find a best fit for both, right? It's a two-sided marketplace in that sense, as in, you might in one of those stints meet your future boss, and then you say, all right, that department is something I quite like. I'd like to go back there, or I just like to stick around here and end my young professionals program here. How I got to find DEG, if I'm perfectly honest, I basically looked into emerging markets investors in Germany, and there's not that many that are active. So it was I didn't know about it before. and I didn't come to DEG with a developmental angle at all. So that made for a very steep learning curve in terms of that there's more than financial returns. But I wanted that because I like the challenge of it, being forced to have that discussion of the two goals sometimes.
And like, do you not feel like maybe a bit of impostor like symbol as you were a bit young? I mean, like you were 25 when you joined like DG, so you're already like an investor at that age. Did you not like feel like maybe an impostor syndrome to be like an investor at that age?
I mean, you don't start off making investment decisions, right?
Okay, yes.
And I was always, I guess it's maybe German nature a little bit. We're very direct and not afraid to maybe too direct at times, but I was very clear that the developmental angle I wasn't too familiar with, but I could demonstrate during my interviews that I still, wanted to learn, and that is something that, was dear to my heart.
Yeah.
So, I mean, you don't search for something like you don't end up at a DFI if you don't align with any of their goals, right? And then in terms of investing activity, there's a lot to be learned. I think the markets that we operate in function very different from developed countries in terms of depth, players, efficiency. So there's a lot to be learned, and I think I picked up a lot of learnings along the way, and the learning curve was quite steep. And I think you have to have a little bit of an imposter syndrome. Well, it's also a bit healthy to have that, right? Because otherwise,
Because you are like at that young age, you are, I would say you are an LP, so you are basically getting money to like 50 years old guy that are trying to hurt. It's like a bit awkward, I would say, at that age to do that. So just why I'm at my.
Yeah, but you don't start out with a board seat, right? Because they don't give you the young professionals, and then you finish, and immediately you get to be, set at a board. How it works is more that there's 1 or 2 more years where you shadow some 2, 3, 4, depending on how much time you need. A couple of years where you shadow a more senior colleague. Join all the board meetings as an observer, maybe ask a couple of questions, and then through that you're sort of kind of, you get all the lessons learned.
Maybe could you like maybe give us an example of a day-to-day task like doing your graduate program?
For the young professionals program, or?
Yes.
So let's say typical, if there was a live deal, on the young professional, we would, if you, for example, work on a live deal, it's a typical analyst position, I'd say, in any other investment, buy side, institution. On a live deal, you run a lot of research, analysis in terms of financials, that sort of thing. And then in portfolio management, you'd support on portfolio decisions that have to be taken as an LP or as an owner of direct equity, right? Sometimes we have to take decision, fire management, for example. But being a regulated bank, you don't just fire the management. There's a process to it, and it needs to be documented, needs to be discussed with my boss and my boss's boss. And you prepare you prepare that decision in cooperation with the lead manager, and then also learn how the decision-making process works through the institution, because there's maybe my boss's boss, then there's back office or risk departments involved, and you learn how to manage all those parties involved internally, and also how to manage the parties involved externally, the external stakeholders, i.e. the management that you want to fire, how to best talk to that.
Okay. It's your
Okay, and yeah, to go back on DEG positioning, so can you walk us through how DEG portfolio is distributed across like co-investment, debt investment, private equity investment, etc., and especially in Africa?
DEG offers I guess the full range of products, i.e. we offer debt and equity for financial institutions, infrastructure, and corporates is what we call everything else.
Okay.
And the funds business, funds and direct equity is part of corporates, which doesn't mean we don't do funds in infrastructure or FI, but just funds can be everywhere in equity. We use funds quite a bit because they have a bit of a multiplier effect, i.e. we write a check, let's say $100 million, and we only write one check, but then it's distributed across, let's say 8 companies by the GP, right? So our reach is much broader and more direct because, we could write 8 checks, but that's 8 times work or more, and we're not staffed like that.
Okay.
DEG has a balance sheet of about 9 billion euros. So has grown that quite a bit. And I think in 2024, we deployed 2.5 billion.
Okay.
Committed 2.5 billion. So that gives you a bit of sense of the turnover that we also have to have. If, a quarter of our balance sheet is due every year. That's quite a bit. In Africa, when African PE, we have about 1 billion euros committed.
So in African funds, when you say African PEs, African like funds
and corporates, so direct equity or co-investment. So it's fun, and of that billion, it's 60% funds.
Okay.
So that's your question. On the 60% funds, so 600 million ish, and then 300 to 400 million is on anything equity that is not a fund. So that can be a direct holding that we have, where we have a direct board seat, or a co-investment. The co-investment, I think, is, let's say, 80% of our direct equity is where we invest alongside the fund manager. So the fund manager, keeps managing for us. That we found that a good way for us to get direct exposure and increase exposure to investments that we like. While also managing, the amounts of commitments in terms of capacity on our end, because it's a very different ballgame to invest into a fund that is very much hands-off, whereas being directly invested in equity, where you're making your own decisions, leading the transactions, that is a lot more involved. So we found the co-investment piece to work quite nicely alongside the fund, and I don't think it's a unique strategy. All the institutions do it, and it has the benefit that we typically don't pay any fee on the co-investment part. While you pay your 2% management fee and 20% carry on the fund side, we typically ask the manager very nicely to manage the co-invest for free. So that's about it. So it's 1 billion, and then 2/3 is fund, and 1/3 is equity. Yeah.
Like, how do you allocate like funds? Your funds like between the direct one and the indirect one.
Yeah. This is a very good question. From a I think the ratio has been relatively stable.
Okay.
Give or take a couple of percentage points, but we want to push more on the direct exposure, because returns there have been a little better than on the fund side, and that is no secret. Every DFI will tell you the same story. Year 7, you're pretty sure whether this is going to be okay or not. But then you're 7 years in, right? And you're not getting out. So it's a very long game, which comes with its own struggles in terms of you need to document and you need to make sure there's continuation within the firm on our end also, so knowledge doesn't get lost.
Okay.
Because over 7 years, I mean, a lot can happen.
Yeah, exactly.
Yeah.
Okay. And like, how do they choose your co-investments?
No, that's a good question as well. So I think you start the co-investment journey by sourcing co-invest. So that means as an LP, we should have a very good relationship with the GP, with the fund manager, and voice that we're really keen on getting some more exposure. That's, I think, step one, and that is not to be underestimated. It's just a relationship game, and you need to be invested in that. And it takes effort on both sides. So that's point one, right? That's our deal funnel. And then we come to our filter. I think there's multiple stages. Firstly, our base assumption should be if we back a GP and they choose an investment, it should on average be good enough for us because we backed the GP in the first place. So we underwrote their investment ability. But then we take a good hard look at it, say whether we like it or not, like commercially and also on the impact side. And this, does this in terms of job created, tax revenue generated, etc. Does this meet our hurdle? And then we go through a valuation process because being a bank, we need to run our own DCF model, which comes with our own cost of capital, which is very, very high. And that is sort of kind of the make or break. So if we like the deal, we like the economics, we like the management team, we like the impact, then we need to get the valuation right. And there we oftentimes have a bit of a disconnect. Because if you are a local investor, let's say in South Africa, your cost of capital is lower relative to a German bank, the German regulated bank's cost of capital. We basically, our cost of capital are anywhere between 15 and 18%.
Okay.
And if that flows into your DCF, a lot of prices don't work out anymore. That's the unfortunate truth. That's the regulatory environment that we're in. It also serves as it serves as a filter on deals as well, which puts a lot of scrutiny on us as well to challenge ourselves in terms of, or challenge the GP in terms of their assumptions on the model, properly understand the underlying drivers, properly understand FX risks, whether they're baked in or not, properly understand the downside case, and then come to evaluation that we all can sign off on. But because the price is usually pre-agreed, right? The GP comes to us with this deal and says, this is the price. Do you want a chunk? And I'll come to the reasons why they give them to us. Okay. For us, that is binary in terms of can we make the price or can't we? And if we can't, if we're super far off, then we have to oftentimes decline just based on pricing. But I mean, that's also how you, I guess it's not if you're about returns, then a good entry price is half the game at least. Okay. So maybe that scrutiny is good as well. And in terms of, I mentioned the relationship, that is important. And then other factors that might unlock co-invest is also deal size relative to the fund size.
Very different.
If a fund has $100 million and there's certain, constraints in terms of how much exposure they can get to each deal.
Okay.
Let's say 15, or let's make it 20% for easy math. Then that's for easy math again, 20 million per deal. But let's say the manager wants to get majority of a company with an EV of 40.
Okay.
And they can only write 20. Then they'll ask us, hey, do you want to chip in 10 or 20 as well? because otherwise they wouldn't get majority and they wouldn't get control, right?
Okay. So if I understand well, you only invest in companies that are owned by the GPs in which you invested.
Yes, and 80 to 90% of our cases.
Okay.
Yeah.
Okay. Thanks a lot, John. Thanks a lot.
Okay, and to go back like on your investment on GP, so we've made like the corporate side to go like on the GP side. So what are your minimum requirements to get GG attention to like stop some private equity funds? How do you choose them in terms like on strategy, fund size, portfolio, etc.?
Yes, that's a good question, and yeah, it's sometimes a bit of a hard message to bring across to new managers or smaller managers. So what we have found through, I mean, we've been investing into funds for the last 20 odd years, and on the PE side, what we have found is that we like bigger funds and experienced fund managers.
Okay.
And that means, if your target fundraise is $200 million, then that is interesting for us, 200 and above. We like experienced fund managers, again, because everybody makes mistakes and
Yeah.
we're all learning constantly. But since our balance sheet has to be maintained, we'd like you to make the mistake with somebody else's money, please.
Okay.
That is just every even really, really good managers, I think their first fund often has a couple of hiccups in there that just couldn't be avoided.
Okay.
So it's typically something like, we'd look at a GP that has at least one prior fund.
Mhm.
So we wouldn't, invest necessarily in first-time teams. And then a third bucket is that we typically don't like to take single country risks.
Okay.
Okay.
Because that comes with more, single country funds come with the higher risk in terms of macro shocks.
Okay.
If you're a Nigeria only fund and the Naira tanks, there's literally nothing you can do. And that is the unfortunate truth. And afterwards there's no, you can explain the subpar performance, but it's still subpar performance.
Okay.
And we'd like to mitigate that by picking managers that have a pan-regional footprint. Maybe Southern Africa and a bit of Eastern Africa. That's fine for us, or Pan Africa or North Africa, whichever
Diversify.
On them.
Yeah. So that's on the PE side. There's no sector agnostic. So whatever you as a GP demonstrate that you're good at, do that.
Yeah, okay.
There's no, we don't, and I think other DFIs are different in that regard, but we won't go out there and say, please, build us a healthcare fund or build us a education fund. If you're not an education investor, why should we force you to learn to be one? I don't think that makes a lot of sense.
Okay.
And it's not the most optimal outcome.
Okay. Maybe here it will be good to understand, like, maybe what are the main point of differences between like a first time GP and a second time or cheaper time one.
Yeah, I think there's not one difference, and there's not the one error that everybody makes that you should avoid. I think it might boil down to complexity and management of stakeholders. Maybe that's one side of it. Whereas complexity, what do I mean with that? There's a whole host of reporting requirements and that your DFI investors would like you to have. a whole host of governance that needs to be set up. That is not, if you've not done it before, it's not very straightforward to actually wrap your head around why we would want all of those things. So that's, I think, on the governance side. On the reporting side, it's quite a bit. If you've not done that before, and then in terms of portfolio construction, I mean, this is me. I've not been in that position, so I need to be very careful. But in terms of portfolio construction, there's also, a method to how big certain checks should be at the beginning or at the end, what type of asset you want to have in year 5, invest into in year 5 versus in year 3 versus in year 1, right? Those are all lessons that you need to pick up at some point.
Okay.
And that's, is again, and from the outside and the hindsight, we're all super clever, but that is something that has to be deliberately done, right? If you look at a venture fund, for example, you should probably not write early seed checks in year 5 if you're not a seed fund, but you're a Series A or Series B fund. Those early seed checks in year 5 don't have time to mature all the way to Series B. But then you're sort of kind of out of time. So those will never generate the value that you want them to.
Okay.
Those things, timing, diversification, are things that are not easy to get right. I'm not saying you can't get them right the first time. And there's examples of people that did, but it takes a lot.
Okay.
Okay, thank you for that overview, Johann. And maybe to stay on that, I just have like one last question. It was when you invest in a GP, have you like what to say in the companies that the GP will be investing during the time of the fund, or nothing to say?
Yeah, I think that comes down to the structure of a fund, a GP LP structure. We are limited partners, and we are limited to governance topics. So we're not involved in any investment decision. I think that's the nature of a fund, of a closed-end fund. We have some say in terms of investment strategy at the very beginning when we negotiate terms, as in the fund, legal documentation very clearly states you as a manager, you are allowed to invest in North and East Africa, and you are allowed to put at maximum 25% of your funds into one company or 15% into one country.
Okay. Like, where do you meet like the GPs? Is it like during forums? Do you have like regular contact with them, through course or through things like that?
Yeah, I think there's the official way and the unofficial way. With the focus that we have on more established and relatively mid to large cap funds, the universe is not very big in Africa, I'd say. It's maybe 20 GPs that fit that description, 20, maybe 30. So it's not that much. And we typically know most of them, with the exemption of 1 or 2. So you informally know most of them, and the part of my job as well as is also to manage relationships. So my job is also to know as many people as possible and to understand what they do and what they do best and what they maybe don't do so well. So that's the part of my daily job. And then we attend all the big conferences that there are. It might be your super return, or your AFCA. Then there's a couple in Europe as well, where we meet with those GPs and also meet with new GPs.
Okay.
And then from there on, we sort of kind of build a pipeline.
Okay.
It takes a bit of time though, right? So if you're a GP who wants to get in contact with DEG, build that relationship. but maybe not for this fund, but for the next. Just because, for example, I first of all need to get to know you, and then I'll rope in, if I like what you do, then I rope in my 2 or 3 colleagues and say, hey, this is a new fund manager, we should really take a look. And that whole process, takes a year maybe, just to get that confidence, get that trust. And by that time, you hopefully have raised your fund. So then we'll follow you for the next 2-3 years and see how you deploy, whether all of this, strategy that you told us you were going to do actually comes true. And then for the next fund, we'll be there and say, okay, we actually like what you do. Thanks for your patience. We built the trust now. For a potential investment. So it takes quite a bit of time, but it's a trust, it's a trust game in the end. You can have all the legal works in the world. If there's no trust to that GP or between institutions, the legal documents don't help you that much anymore.
Okay, very interesting. You mentioned like the fact that you are only interested in large cap funds. What's the range of the large cap like in Africa?
I think it's between 200 million and 750. Okay. I think there's 1 or 2 larger that are close to $1 billion, but those are 1 or 2 names, and the jury is out there whether that is something that can be repeated in terms of fund size.
Okay.
But our typical fund is, let's say, between $300 and $600 million.
Okay.
That's sort of kind of the size. Yeah.
Okay. And how do co-invest like with other LPs? I mean, like when like maybe the size of the fund is a bit like too big for you. Like, how do you choose? Maybe I don't know if you choose the other LPs to help you investing in this fund, or is it like the GP that is like maybe pulling you aside the other LPs in order to complete the fund? How is it like? How is the process going on
in terms of fundraise and how to get to that size?
Yes.
Yeah. That is an interesting process. The fundraising is nothing. I don't think anybody enjoys fundraising.
Okay.
It's neither on our end nor on the GP side, because the GP needs a lot of momentum to get everybody rallied up to say, all right, let's first close. And that's once you have the first commitments, that's the first close. And that's when you as a GP can start investing. And you need to do those investments to show further LPs, future LPs, that you're already, in the market, that you're doing well. But it's very hard to get that momentum for institutions to make the first step.
Okay.
Because why would we be the first ones, to take the risk and sign when we don't know whether there's nobody else coming, right? So it's that chicken and egg situation, where DFIs typically work together quite nicely, in a sense that I would speak to my counterpart at VII, which is the British, or Proparco, which are the French, and we talk. Do we like this GP? Don't we like this? And then we form a consortium of, let's say, 3, 4, 5 first close investors.
Okay.
And run the process in parallel or combined, with or against the GP. Negotiations are not always, there's some confrontation at times, but we all have that goal of getting to a first close. And once you have that momentum, there's a good chance that you get that first close. But it's really tough. And the scarcity of capital in Africa makes it so that GPs, let's say, rarely pick an LP. It's mostly they want to have as many as possible because that gives you a bigger fund.
Mm-hmm.
I think that is different in developed markets, where let's say a Sequoia, for example, or a KKR, or they can sort of kind of say who gets to come in and who doesn't. So it's a bit of a different world.
Okay. And do you think that there is also other differences between like African GPs and European GPs?
Yeah, I think first of all, size and maturity of institution is different. So a Carlyle, a KKR, they've been around for decades. Well, their entire platform, they operate as a platform, right? They don't operate as the GP with 2 or 3 funds. It's a platform. They have a lot of shared services. So when a new fund comes live, everything is lined up, and they know the drill. And while we have experienced GPs in Africa, they rarely have this big platform behind it that has processes fully standardized, that has governance, fully standardized and up to top notch. And that's just a function of size, right? Size and maturity. It's not to say, GPs here can't do it. It's just, if you have 20 billion AUM, it's a completely different game to 2 billion AUM.
Okay.
Very different.
Okay.
So I think that's where there's a lot of difference. Yeah.
Okay. And you said, so when you choose like to invest in a fund, there is like what you call like first close, second close, final close. So can you like walk us through that process and how does it work both for you like as an LP and for the GPs as well?
Yeah. I think the hardest part is the first close. And you, as an GP, you want to time that very right, so you have enough size to start investing, and they're not stuck. You don't want one LP to give you, let's say, $50 million. If your goal is 500, then you're only at 10%, and you can't really start investing with that. So if you want 500 million, you probably want a first close at, let's say, 150 or 200 million.
Okay.
To allow you to write the first checks. And then the typical, documentation says that from first close, you have 18 months to get to a final close.
Okay.
So there's then this clock starts ticking to, rope in as many LPs as you can as a GP to, invest into your fund, while at the same time show and demonstrate that you're executing your strategy. Which, after first close, you can then go to future LPs and say, look, I've already written 3 checks. These are amazing deals. You can actually see them. They're performing well, and they're all within strategy. And that helps you to get momentum going and overcome that, build a bit more trust, because at first close, it's a blind pool. We, as a first close investor, we purely trust your legal documents and your track record.
Yeah.
You do that exact same thing or a little different in the future. Whereas at second close or final close, the LP can ideally see what is in the portfolio already. Maybe not all the deals, but quite a few. And there's a bit of, I think, from a commercial point of view, as an LP, you would really only want to be in final close. Because you are not taking as much risk, because there's 1, 2, or 3 deals already in there. You can take a hard look at those deals and say whether you like them or not. And ideally, in that year between, let's say, first close and final, or 1.5 years between first close and final close, those deals have already appreciated.
Yeah.
Let's say 10%. And then you could get into those deals at a lower cost and immediately mark them up.
Okay.
So those economics also play a role why the first close is so hard, because everybody's waiting for the final close.
Right.
So it's really hard to, get the momentum. Sometimes the first closer will have to, be given discounts, some favorable terms just to come in. Yeah.
Okay, no, that's really interesting. And like, if you like choose the GP, like if you say, okay, I will commit like 20 million to that fund, are you like do you like commit 20 million like upfront, or can you say, okay, I want to commit like 10 million in the first close and 10 million maybe the second close? So how does it work, and like have you like flexibility on that as well?
Yeah, we as DEG we have flexibility on that. We don't have a target ownership or ownership that we strive to. Our typical funds or typical stakes, our LP stake size is about $20 to $50 million.
Okay.
So anything in between. Whereas 50 is more reserved, is more reserved for the guys that we really, have a long-standing relationship with, and that we appreciate, the performance and the impact of. But we can, split tickets, and we've often done something like, let's say, 20 up front and the first close to, also have our role to mobilize capital, to, fulfill our role, mobilize capital, manage a first close, and then let's say a year later or 18 months later, write another $50 million check, so 15 for combined exposure of 35. That gives us a bit better return, reduces risk a little bit, and also sends a strong signal to the market that we really like these guys and ladies who managed the fund. If we almost double our exposure after 18 months.
Okay, that's really interesting. So like this is the first part of like the life of a fund, like is investment, and then I have like two questions in one, but how do you follow your commitment during like the fund's life, and especially in Africa? So how do you manage like the risk of an African fund? I guess that there is like so much risk compared to like European funds. So as like an LP, how is your role in that?
Yeah. So I think you're right. There's typically two phases, right? The investment phase and the harvest period, to 5 years and 5 years. If you're talking about a 10-year fund, which is the standard model, those are blind pools, right? We are limited partners, so what we can influence is on the governance side and on the relationship side. And I think that's where maybe work in with African funds a little different, because we as DFIs have quite a direct relationship to the GP, which I'm not sure you have with, again, a Carlyle or KKR. If you are a family office in Europe, putting $20 million in a $2 billion fund, you probably don't have the same close relationship as we have, which, that's part of why the job is interesting. At least you have the sense that you're a bit closer. And then what do we do? I think the first 3, 4, 5 years is pretty, easy sailing, in terms of we can't influence much anyway. We just need to check in, say, all right, what's your pipeline in terms of deployment? What's your fundraise look like? Is there anything that we can also do? Can we provide any technical assistance? DEG has a pool of money that we can use to improve, for example, the fund or the portfolio of the fund in terms of energy efficiency, governance improvement, greenhouse gas accounting. Those are all things that we support the GP and the investees with. So can we do that? Cool. We check in terms of co-invest. While you invest, is there anything where we could participate? And we typically do that through 2 channels. One is the informal one, where there's a WhatsApp on a Sunday afternoon. Hey, let's maybe grab a coffee next week. How are things going? And then there's the official channel that is on the advisory board of the fund. We typically ask for a seat at the advisory board of the fund, the so-called LPAC, Limited Partner Advisory Committee. where governance topics are discussed that are not, meant to be shared with the broader audience. And those meetings happen twice a year typically. And in those meetings, we engage deeper, discuss each company, see how the progress is going, how they're tracking versus budget. But we're really just a check in terms of check and balances. Okay, we're not involved in the day-to-day operations of the GP. Through that 5 years, through the entire holding period, we manage or we measure our impact and see that is on track, but that's very closely tied to the investment as well. And then in year 5, 6, we start to be maybe a little bit more annoying and say, and put focus on realization and liquidation of the fund. That is something that I think that's only, DEG's Africa portfolio that I can speak for, but that we've come to realize is that, we need to remind and adhere to remind, everybody of the signed document of the holding period, and we need to make sure that we adhere to them, because at some point, at the life of a fund, there's not much more value to be gained. And we have the benefit of a bird's eye view. We see we have about 40 LP stakes in our active portfolio right now across vintages. So some are 15 years old and some are 2 years old. So we have a bit of experience in terms of if a fund in year 9 is not in carry or is not at par, it's not going to get there. We know that from experience based on statistics. But as a manager who's deeply involved with each company, you sort of kind of need to have that belief that there's still value in there. And we need to navigate that struggle a little bit, and we try to address that as soon as it's time. So in year 5, 6, 7, we really try to challenge the manager in terms of, is this value the value you can exit it, or is it credible that there's more juice in it? And that's not always an easy discussion.
Yeah, it's year 6, like you look at the door and you say, okay, where's my money?
Yeah.
No. Yeah, go ahead.
No, it's that is part of the game. It's I think holding periods in Africa are a topic that's out there. I think the industry is aware that you can't keep raising money if you never return money. So there's awareness there that money has to be returned, but it is not easy. Point one, right? Because the markets are not that deep here. And then, whereas let's say in Asia or maybe the US, you can, after a good restructuring of a business, you can get a massive multiple expansion in individual companies, and we've seen that in our portfolio in Asia, where it's held at, let's say, 7 times EBITDA. It's then sold for 14 times 2-3 years later.
Okay.
We don't see, and that sort of kind of gives you hope that there is still juice, but we don't see that on the continent.
Okay.
I don't think I have a single example where we have that in our portfolio happen. So that sort of kind of upside kicker is not there. And therefore, if you're not in the money, you're not in the money. But then to realize that, and I think it's a hard realization that, this is maybe good, but it's not great. That's tough, and that's also tough to communicate, right, to your investors, to say, well, I set out to do 10%, but I've done 5. These are the facts. It's 5. So that's just not a pleasant place to be in.
Okay. Very interesting. And like in an like overall way, are like African PGPs making like good money? If not, like what are the main points that you see are today the limits of private equity or debt or VC like in Africa?
Yeah, I think It's a good question. The question on what is good money. I guess that's up for. But when we sign an investment, right, it's typically your hurdle at 8%. That's a very typical hurdle. So that should be our goal, 8% or above. Net after costs, after fees, net to the investor. Do funds in PE typically get there? I'd say for the, we do the analysis quarterly in our books for Africa, and we've had over the history of DEG about 50 to 60 stakes or LPs investments. Okay. We still have 40 on our books, so 20 are exited, or 15. And on average, they don't make those 8% in dollars or euros.
Okay, like what's maybe like the maximum like a return like you did have like really from?
Yeah, no. So I said on average, right? There's good managers out there that track 8 to, let's say, 12, 13%. Okay. Net of fees in euros in our own book.
Okay.
So that's the top end, I'd say. That's the top end of what you're gonna get as of now, as of today. And then there is anything between 0 and 8 or 0 and 6. That is a large chunk, and then there's a smaller chunk that is not going to give you your money back. I think that's very natural in the portfolio construction. What and PE is an issue is that topic of exit, and it is there's multiple factors, right? You of course have a dollar fund typically, and you invest in local currencies. If you look at the rand, the naira, the shilling, pounds, they've all had, or Egyptian pounds, they've all had substantial devaluations in the last 5 to 10 years. And there is just very little you can do against that. Mm-hmm. Even if your business grows tenfold, even then it's really hard to translate that in dollars again and still come out on top.
Okay.
And that's one thing that's just very hard. And with that comes that's pretty much tied into all the other struggles in terms of, if you grow quick enough or if you grow big enough, then who's your buyer? The buyer universe is also relatively small for certain sectors. So your exit routes, in very PEs typically is, your strategic investor. That typically has worked best, and I think has resulted in the best returns, especially if it's a foreign, like a global investor or strategic that comes in. But you need to be very sure to find that strategic investor. Okay. And they're not waiting around, right? So you need to be very, very certain that this might be an actual route. We are in the logistics company here in South Africa that, and we got in, and part of this thesis was that Amazon entered South Africa. So there's your strategic. Yeah. But we haven't sold to Amazon. There's a long way to go. Yeah. There's the potential that there's a buyer, and there's a history of Amazon acquiring businesses. So that has typically worked well. Then there's other PE funds that can buy secondaries, that we also see a lot, which it's an exit, but in our portfolio it oftentimes is an exit from one fund into a new fund, and both funds, we are invested in both funds, so it's net neutral on our end. So that's not optimal. And then I think we've seen IPOs, especially in Morocco lately. I think we've had 2 in our portfolio, 1 direct and then 2 directs actually listed in Casablanca. Okay. And that has done really, really well. Because I think there's a lot of appetite by insurance companies, pension funds, and retail investors in Morocco to invest into local companies. Okay. Those are local Moroccan companies. Those are not, North African companies. And there's a little bit of patriotism in there, like, you know, you want to back your own champions. That has worked really, really well. But yeah, everything in between, and if you're not quite sure who your buyer is, I think it's difficult.
Okay, so if I understand what here, you mean that like the main limits of like working in P in Africa today are like the FX on the first part and then the exit.
Yeah, I think that is roughly, if you know, if it's PE in terms of Pan-African and you want to, you know, raise money from institutions. I think if you're at that scale, I think exits is a big thing, and then FX risk is a big thing. There are probably ways to overcome it, but I'm also just a, you know, backseat coach. So, you know, it's again, in hindsight, is always easier said than done. And when you're in the thick of it, you know, you can't see the wood for the tree, or vice versa, the tree for the woods, whichever way around it is. So it's you know, easier said than done. I think there's, you know, pockets of more local, smaller capital that is very agile and very commercially, you know, successful. But those are not your those are your family offices, local family offices. So they're in real estate, they have the holding here, holding there. They don't follow that typical fund business in terms of 10 plus 1 plus 1, 2 and 20 that we've been talking about here. So that's very different, and that is nothing that we as a DFI would get into, I think. Yeah.
Okay. Notice that's really interesting, and so we have talked about like frameworks of a live fund. So we noted like a few examples of recent fund that DG has invested in Africa. So Mediterranean Capital Fund, Amethyst Fund 3, Altera Africa, and Partech Africa Fund 2. If you can take like one or two example of that funds, Johann, and walk us through what was like the strategy of DG in those funds. Maybe we have like Partech, which is a VC fund compared to Mediterranean, which is like a large cap fund. So what are also the different, like in terms of DG commitment and in terms of returns expected? So I think that it will be interesting for our listeners.
Yeah. No, I think Mediterranean Capital 4 is a good example of a fund relationship that we, you know, doubled down on. We initially invested 25 million, and then at final close that was at 600 million, which is pretty successful. We added another 15. No, sorry, I guess we need to cut, but I think in total 25, right? So we had 10, and then we doubled down to 25, which is a good example of how we, you know, looked at the strategy and also saw the predecessor fund develop, and the predecessor fund has done really, really well in terms of our entire book. They have very strong liquidity, you know, just returned a lot of capital early, which again, that's good for your IR, that's good for your distribution to paid in, your DPI. And we could already at final close, right, as I said earlier, we could already see the entire portfolio and said, all right, we like all of that. The development is on track. So, you know, it's de-risked. And Mediterranean itself is, for us, has turned into a very strong regional partner in North Africa. We've co-invested with them, and yeah, the experience overall was good, and you know, validated that we would like to increase our exposure. Yeah. So that's maybe Mediterranean, and yeah, I think we can. Amethyst, Altera are good examples of funds that have been around, managers that have been around, where there's a strategy that we like. that is tested, that has, boots on the ground, as we like to call it. So they're Pan-African, truly Pan-African. They've shown us exits. They've shown that they generate sustainable impact through jobs created, tax money generated, and that are highly motivated teams, right? I think it's always important that the managers is very, very motivated themselves to do better than just manage assets, but also to do really well.
Okay.
And then Partech, I think you asked about that.
Yeah.
I think the Partech was our very first venture capital investment in Africa, which I think Partech, the second fund, lends itself very well to, because Partech, being a French, very big, established, experienced venture capital platform, sort of kind of brings you that entire platform ability that I spoke about earlier. It comes with a deep experience in the sector, across regions, across stages. So they have, pre-seed strategies up to growth capital strategies. So everything's in there. And the platform also makes sure that the knowledge is shared. So the pre-seed guys will talk to the growth guys and say, hey, we've seen ABC, you should really consider some lesson learned. And so that's something, together with the two partners in the team, that we liked quite a bit. It was, I think, in 2022 when we committed. That, to be fair, was also at the peak of venture in Africa.
Yeah.
So the predecessor fund, Partech Fund 1, looked stellar. There's no other word. It still is a pretty good fund. Like, don't get me wrong, it's still doing pretty well. But at that time, of course, it was like, okay, this is shooting the lights out in terms of money multiple, IRR. We'd be silly not to back them. We've gone through a bit of a correction in the last couple of years. The team also had to learn quite a bit, but they're on a good track, and the portfolio in Fund 2 now looks pretty solid. We're very excited to see how that goes. And then you wanted to know about returns, right? Return expectations.
Yeah, exactly. Between like a fund like Mediterranean or Partech.
Yeah, I think because we are our bread and butter is private equity.
Yeah.
That's sort of kind of our benchmark in terms of return. In Mediterranean, Altera, Amethyst, we all think they should perform with what we call top quartile. So we look at our portfolio and say, okay, the top quartile funds of each vintage has X% IRR, and that's somewhere between 8 to 12% net euros. And we'd expect any of the 3 PE funds that we mentioned to land there, hopefully better, right? That's always the case, but realistically, anything between 8 to 10 is very decent, and 8 to 12, or 10 to 12, 13 is very good.
Okay.
Again, could be better, right? But I think that's what we can aim for. And then Partech in venture, since we allocate to venture when we think there's higher return to be made than in PE. Given the risk return profile of a venture fund, we typically aim for something that's above what I just said, so above the 12, I think 12 net. Yeah, that is something that makes the asset class attractive to us. That is still to be tested, right? We have not seen entire funds being liquidated. We have not seen the entire life cycle yet. And especially that stage where Partech is operating in CSA, CSB. So it's still to be tested, but I think that's our thesis going into it, is that we can probably hope for 15%. But maybe I'll stand corrected in 5 years. Hopefully to the higher end, but yeah.
Okay, you will do like a second part of the talk in 5 years, so you can like give us your feedback about that.
Yes.
So yeah, at Akinya, so our goal is to like make private African private market more clear, having like giving the African and finance ecosystem more clarity on data, on transaction, on deals, on company. So I wanted to know how like DEG monitor like the African market. Do you have internal database? Do you go on public sources? I guess you also have like local partners in some countries to give us like information. So how do you do to monitor the market?
Yeah, that's a very good question, and I think one of the key pain points that we have, because your typical PE benchmarks, as in Cambridge Associates or Carter, those are the typical institutes that would publish benchmark data, is very, very scarce for African data, and I'm not quite sure why. But sometimes for certain vintages, they would have 1 or 2 funds included. When we know we had invested in 4, so there has to be 10 at least that should be around for a given vintage.
Yeah.
So that is a bit of a struggle. There's local data by African Private Capital Association, AFCA, for example, that we also utilize in terms of deal activity, fundraisers, etc., etc. But that again, right, that there's a bit of selection bias, who reports data, right? If you're struggling, the last thing you think about is to report data. There's always this bias in the data. There's a bit of our own market intelligence in terms of what's going on, but that's also again very, very biased. On the direct side, we look at Capital IQ, Bloomberg, rating agencies in terms of also deal activity. But again, right, what is being published and when is it being published? There's always a huge lag if it's being published at all. So it's quite a bit of a hassle to get any reliable data and in big enough quantity. In terms of performance, we've found the best way to measure performance. It's a bit of a circular reference, but is to see how our own portfolio is doing, because the hypothesis is, right, we've done our best job to select these funds.
Yeah.
They should be the best that there is in each age. It's not always true, but overall. So we found that tracking the performance of those funds quarterly, ranking them internally, and then deducting whatever data point we can has worked best for us. And on venture, it's even fewer data points. So there's Carter again, but Carter has hardly any African data. And then there's sources like the Big Deal, which is basically a Substack, and Partech publishes data once yearly. But that's very aggregated, and then comes out a couple of months too late for us. So we've found alternative sources of data which are also not perfect. So it's a big struggle to be up to date and have objective data. That's true.
Yeah. So from what you said, so even for large institutions like DEG, data, like it's a cornerstone, and like the scores of reliable data in Africa is make like things really difficult for you, I guess. So from your point of view, what do you think that platform like Akinya can help you as an LP to help you like in your day-to-day work?
Yeah, I think twofold, right? There's one on the, I think, market discovery side, where if I can have an objective database that says X, Y, Z has raised or has closed or deal signed, I can check with my own relationships, say, oh, I didn't speak to those guys, or I've never heard of those. I should really reach out to them, or maybe I know that deal, but I don't know what happened. So more of more of an insight of that is beyond my horizon or beyond my tiny echo chamber. So just to make sure that we see more than we think we do, because there's always this bias of if we don't see it, it doesn't exist. But if we know that it exists, then we should actually take a look at it. And then on the direct side and in terms of DD, again, if there's more data or information out there that we can access, it would help us validate a couple of trends, underlying theses that we have going into an investment. For example, we get there's a lot of interest in Egypt right now, and I think that's objectively true, but I can't give you data points on it. I know that we've seen quite a bit. I know that a lot of managers are actively looking. I know it's also been doing well in the last year post devaluation. So all good data points or sentiment, but I cannot give you, or I need to look very hard for data points. And then that Akina would really help in that we'd added more objective sources of data or sources of truth there to educate our decision-making process.
Okay. Yeah, go ahead, Christian.
Well, thanks a lot, Johan, for this insights. This is really like the goal of Akina, so to give a more clear view of like the whole ecosystem, the private capital in Africa ecosystem. Maybe like we have been there like for 1 hour and a half. I think like maybe to close the discussion today, we have like few questions to have on the review. Asking you like what do you prefer between direct investment and indirect one?
I think you're always close on the direct one, right? Even if it's co-investment, you always feel more involved. You also are more involved with the individual deal. So that is more closer to, let's say, your M&A practice, your buy side activity. That is true, but the fund side, if you are involved, it gives you a lot of data points, and you have that. You have the benefit of a bird's eye view, which gives you the ability to. Again, there might be bias in it, but try to figure out trends that are overarching. So while it's not in the detail and you're not looking at budgets on a day-to-day basis, you are still learning quite a bit in terms of strategy, in terms of trends, etc., in terms of lesson learned. So I wouldn't say there's from the deal making side that the co-invest or direct is a lot more fun because it's less cookie cutter. But in terms of having the ability to see into a variety of portfolios, that's also quite interesting.
Okay, maybe in the same like topic, I had also one question to close the talk. So if you could like talk to the Johann 5 years ago entering like DEG, what piece of advice could you say to him?
Yeah, that's a good question. Yeah, I think look in terms of in terms of a DFI, DFIs are government closed, while DEG is not directly government owned, but it's close to a government institution, and other DFIs are more extremely so. So there is a bit, we're not very fast. We're not, our decision-making processes take long because there's a lot of stakeholders involved. There's a lot of, let's say, institutional experience that you need to distill somehow. That doesn't show itself quite clearly. So you want to, take an action, but then somewhere, somehow thinks that action is wrong because of some prior experience. And it's never quite clearly distilled. Like, this is the lesson learned because of ABC. It's more in the sentiment of the organization. And I think if I had to go back, I should expect to be a bit more patient, and to give time, to also with my colleagues and counterparts, have time to process and understand why a decision was taken in A, B, or C way, and not get frustrated with the way that things are or the way that the decision was being taken. I think when you would come into a job with relatively young and some experience but limited, corporates are corporates, right? They're not entrepreneurial institutions. They don't function that way. And I think that's something that 5 years ago I thought about it a bit more entrepreneurial, which works to a certain degree and has its perks. But it's just the speed of everything is a bit slower.
Okay.
Okay.
Yeah.
Okay, Johan.
I don't know, Christian, if you wanted to add something.
Like me on my side, I wanted maybe to know, like, you told us about like the FX issue. Like, so you are DEG, you invest in euros or dollars, and then like the firm had to like take all the money like in local currency and then give it back to you or in euros. So in my like maybe limit job performances. So do you think that one of the way to mitigate like this risk is to have like more local LPs first, and like how do manage maybe at DG, how do you manage to involve more local LPs like investing in the P or debt or Eastern Africa?
Yeah, that's a very good question. Our balance sheet is in euros, and that's not going to change. And there is a massive disconnect, right, between the local currencies and then whatever hard currency we're talking about. Local capital is always best, and that's that's the reason why we exist, to foster that local capital and to capitalize it and to go into first closes when there's no local capital wanting to go in the first close. That's why DEG's mandate exists, to crowd in more capital, and to also set up standards and in terms of governance, best practices, and all of that, to maybe de-risk, maybe say, look, we've built this to build a bit of trust. So yeah, local capital is absolutely one of the key topics that we have and that we want to crowd in. It's just, I think overall, it's the financial industry it's in South Africa is very developed, but it's also not very old. If you look at pension funds in Europe and the US, they're just very old, so they're very experienced in terms of asset classes, allocation, etc. But I don't know how old the South African pension funds, for example, are. They're probably not that old, and they certainly don't have the deep knowledge about alternative assets. That's just something that builds over time. So you can't force it, right? And it has to develop over time. And then I think the pension funds are becoming more active. I think we see Kenyan pension funds, South African pension funds, sovereign wealth funds being active, local funds, but the amount of capital is, because they're trying it out, is not massive. And because they don't have the experience, they're also not super confident to, invest vast amounts of their retirees' funds into an asset class where they're not 100% certain, because, and that's a problem, right? We have, if your treasury bills in any local currency, look at Nigerian or Kenyan treasury bills that give you 15 to 20% annually. And it's very hard for a PE fund or the PE industry to outperform against something that's almost certain, that is known and understood by the pension industry. So it's a long way to go, but it's a patient game. Realism takes time, and it's a young continent, so we need to give it time as well.
Thank you.
Yeah, thank you for all those insights, Johann. The last question that we wanted to ask you, and what we ask to all our hosts, is like, if you wanted to hear like maybe one or two people in Akinya Talks, who they be, if you got like one or two names that should be in our talk.
Yeah, I think somebody that would be very interesting to talk to is one or two individuals from AFDB, being the African Development Bank. I think they're involved in everything, and they're a super important player on the continent. That is certainly something. Maybe someone from a pension fund could be of interest as well, because we just touched on that, and the lack of capital. It would be very interesting to hear their thoughts, and also what holds them back. And then lastly, if you look at the venture space, because Akina is also just starting out, maybe something about building in Africa or building for Africa could also be of interest. To just bring more voices or different voices onto the podcast.
Okay, so thank you very much, Johann, for your time. We really enjoyed this talk, and this is why we are making this, really to bridge the gaps between investor, entrepreneurs, development funds, etc. So once again, thank you, Johann, for your time, and make sure to follow Akinya and stay in touch for the next episode. Thank you, Johann.
Bye.
Thank you.
All right.